It's almost like the calm before the storm, or down here in South Florida, I've been through hurricanes where the eye comes right over the top and you get this period where it's calm and there's nothing going on. You think it's all over. And then the backside of the storm comes and it's not over. The worst part of it. Yes.
Hi, everyone. Welcome. I'm Maggie Lake here with Shawn Hackett, president of Hackett Financial Advisors, and we are going to take a deep dive into the world of agricultural commodities. Hi, Shawn. It's great to see you again.
Hey, Maggie. Nice to see you again. I think it was late January the last time we did something together here.
Yeah, absolutely. And I've been looking forward to this because I tell you, I get questions about ag commodities almost every day in the daily briefing. It's something that loads of people have been watching. We've seen an enormous amount of action there. So it's going to be really great, I think, to unpack some of what's going on. Before we jump in, though, for those who are newer to your work, so you specialize in examining how major weather patterns impact key crops and producers around the world. Is that a fair description?
Yeah, I mean, we really view agriculture that they're weather derivatives. Sure, lots of things do impact the price, but the number one fundamental that impacts the price is what's the weather going to do? What kind of crop potential are we going to have in these main growing regions? If you can get that correct, which is what we spend a lot of time getting right, directionally, you're going to be getting the market correct. Now there's other things you use. So how far will it go up or down? But weather is so important, and we spend a ton of time, as you know, on these natural climate cycles and these shorter intermediate and longer term cycles to really put out 1 year, 2 years forecast, so our customers can prepare well in advance for what they have to do on the farm or what they want to do with their money.
Which is so important. But it's been a really interesting time, hasn't it? Because since we spoke in January, it's incredible how much has happened since then. It was sort of very eerie, actually, because I went back and it was just before, we sort of had this new wave of geopolitical concerns. Russia invaded Ukraine, obviously sparking massive concerns about food shortages and famine. We have inflation running red hot. We saw 360 by central bankers. And we still have COVID massively impacting supply chains, particularly in China, where they're, in the midst of yet another severe lockdown, something that's been really hard to handicap. And I think a lot of people thought we were going to be through at this point. So how do these big geopolitical and macro factors impact your forecasting model? How do you overlay that?
Well, just remember, we can't forecast a geopolitical event before it happens. I mean, we can speculate it's possible. China might go into Taiwan, but we don't know if they are or when they're going to. We just know that those are what we call outlier risks. So when we make a forecast, when we're trying to make a price forecast and we're looking at the weather, we're looking at the things that we think we can predict. And then we say, okay, within that construct, if some of these outlier events, where would our upside be or where would our downside be, and make sure our customers are aware of the outlier risks. But that what we're giving is what we think is the most probable course. And of course, if we need to pivot, then we pivot. I mean, that's just the way things go. Sometimes you have to do that. When I think we might have been a week or two before the Russian invasion when we had our forecast, and of course, just crazy times took place. And now we're on the other side of that, where we're having crashing agricultural prices and deflationary fears coming in, and economic fears coming in, and the dollar rising, and the Fed, just a whole bunch of different factors now versus, what's been going on or what's been the talk of the town here for quite a while. And so we're on the other side of this argument now. So yeah, and I think you do bring up a great point. I think this is why, we've been cautioning, and more importantly, not me specifically, but when I interview people who have a lot of experience in the commodity market, more general commodity market, do caution people to be really careful, because I think you just laid out there are so many cross currents that hit agricultural commodities that it's really tough. But I'm fascinated to hear what you're thinking about all this, because I think if you've got that fundamental weather down, it's going to give you an idea whether it's going to exacerbate an already really bad situation, or right, whether there's going to be a little bit of tailwind and maybe a little relief somewhere along the line that can help with supply constraints. At least that's how I'm thinking about this as we head into it. So let's
talk about the volatility a little bit. I mean, you just laid it out. The reason we get so many questions about it is because for the first half of the year, especially the first few months, ag commodities were some of the best performers across the asset class. Soybean. I think by the time they still tallied it up, there was something in the journal recently. Still, when you hit June in the midway point in the year, you had soybeans up 26%, corn up 25%, orange juice up 22%. But a lot has happened since those sort of half-year benchmarks came out. So are you surprised by the volatility? Do you think it's going to continue?
We're not surprised by the volatility because much of the volatility is being driven by the weather volatility that we've been warning about and discussing on Real Vision and elsewhere for quite some time. And we don't see the weather volatility going away. We see it actually escalating in the years ahead. And so the price volatility is here to stay. And it does appear that when you get into these what we call longer term inflationary cycles, especially where food gets expensive for many, wars do tend to occur. You do tend to get altercations. You do tend to get unrest. And that's every major agricultural bullish period has always had war or rising tensions as part of it, because those that have the food and those that don't have the food, it just becomes a really difficult geopolitical thing to solve. And that's, we saw a little bit of that when that Russian invasion took place, of how that quickly, we can get into that situation. The good news is our weather work has been saying that we should see at least a little give back in the weather. I mean, we expect to be a little better here over the next growing cycle, give us some better crops and give us a pause in the action, a chance to rest, to regroup before we get into what we think could be a 1 in 100 year weather event in 24, 25, which we can talk about later when you feel to do it. But we really want to impress upon everybody that we feel, when you look at the cycles of commodities and agriculture, that we're in one of these 20-year bullish periods. Doesn't mean bullish every year. Yes, it means big breaks along the way, but an overall bullish period for the next 20 years, which means that every break that we see, we want to be looking for opportunities where the weather is going to be most adverse. And so we've had our first big break, Maggie, from the 2-year move that we've seen from 2020 low. And so we think this next period coming up over the next 6 months to 12 months, we're going to be looking for opportunities, especially in those markets like grains that have really, really gotten hit hard here lately.
Yeah, so that's really interesting. So this is, I think if we're talking about oil, the oil folks like to call them super cycles. What are you calling it, a 30-year cycle? So this is what we would know as a super cycle for ag commodities, for all the commodities, or is it going to depend?
Well, the 30-year cycle means every 30 years you get into a situation, and we laid out the 3 important pillars for a move higher. One is that you get some kind of currency misallocation. This particular time, it was the dollar against Bitcoin, how Bitcoin appreciated so dramatically against the US dollar, creating this devaluation, this inflation concern. We always tend to have an escalating weather volatility period, like the Dust Bowl in the 1930s, like the global cooling scare in the 1970s. In past Real Vision interviews, we talked about the grand solar cycle minimum, which is a period of lower sunspot activity that does tend to rapidly escalate weather volatility, as well as the sea surface temperature cycle going into the cold phase. All of these factors tend to come together and culminate and create these 20-year periods where you have bullish, factors that are driving the agricultural markets higher because of the weather, but it also is just a general commodity cycle. I'm not one that spends every day looking at crude oil or looking at gold or looking at copper, but they all do tend to move in the same direction, but you do have an outperformance at times. And we feel this particular cycle, because of the weather cycle, meaning we have not had this grand solar cycle minimum and the sea surface temperature cycle together in over 400 years. So it's been a long time that we've had this setup for weather volatility. That means to us, the agricultural space should be the overall outperformers, where in the last cycle it was energy that really, really led the way.
Fascinating. So, I think I heard you say before, and this is incredibly important in that sort of massively bullish 30-year cycle, which isn't, if we've just started it, not gonna top out for some time to come. That doesn't mean it's a straight line up, straight shot up, right? And that's where it gets dicey.
Well, it really does. Everyone says, "Oh yeah, it's a long-term market. I can withstand the downside." No, you can't. I mean, you just can't. Maybe you can, but most people are not able to monetarily or psychologically handle these big, sharp downturns like we just saw. I mean, they're vicious, they're brutal. I mean, we turned extremely bearish, Maggie, the grain markets in May, and put out a strong recommendation for our farmers to cash sell, because we saw a lot of our capital flow, smart money capital flow work, our improved weather outlook. And we always follow the simple concept that when everyone is talking about a particular topic, it's time to change the trend. And we just got to a point where I couldn't find anyone that wasn't saying the same thing. And in the 35 years I've been doing this, anytime everyone's on the one side of the boat, for whatever reason, the market has the ability to get everyone on the off sides and get it to go the other way. And we just felt we were at that point. And so even though we're long-term bullish on agriculture, Maggie, doesn't mean we're not going to be bearish at times. Doesn't mean we won't tell our farmers to sell. We will. It just means, generally speaking, we're more interested in the buying opportunities than the selling opportunities, because we think there's going to be more upside volatility than the downside volatility, especially this early in the cycle that we're in. We're only a couple of years in to at least a 20-year move higher overall.
Understood, right? We're in the channel. Although, yes, as you point out, and we'll show on the charts, some of these spikes down this is not in the same way it can go up, this is not a gentle drift.
Just think that, Chicago Board of Trade wheat dropped $6 a bushel from the high on the Russian invasion to the low it hit a couple of days ago. I mean, that's quite a decline. It's quite a decline.
Yes. Our good friend Tony Greer called it face ripping, a face ripping decline.
Face ripping. Now, can you withstand that? Maybe
Nobody
you can, but
nobody wants to. It's hard to recover from those drawdowns, especially if you don't have to, which is why we always caution, be careful in this space. So, first of all, are there participants in the market who weren't normally? And I hate the term meme stock. I think it's derogatory and disrespectful. I just don't like it. But has this become like a crowded trade? The trade of the moment where people are like, oh, ag is hot, we're going to have famines, I'm going to jump in there. And is that why we saw this deep decline, or are there fundamentals that are suggesting that?
Well, certainly we just talked about it. There was too many people that were on the same side of the boat, all thinking that they found their trend. What was it? The cover of The Economist said, famine coming. It's just classic contrarian. Anytime you see a cover say something, the death of commodities, I think, was Time magazine in 2020 was the bottom. So, these anecdotal things we look for to say, long-term trend looks good, but the short-term trend, probably just too many people in here that ought not to be in here. But there were fundamental trends. The weather, in our way of looking at the weather, most weather forecasters were saying this is another La Nina year. We're going to have another escalating drought. It's going to be hot, dry. It's going to get way worse. And we were very contrarian in saying that our work suggested that we were going to see a cooler, wetter growing season, and that we would see better production than the last couple of years, and that we would see, it doesn't mean perfect weather, but much better go of it. And at some point, the market would start putting that together and saying, boy, we're going to have some better crops here. And sure enough, we start, when you get into July, the market starts to look out ahead and say, we're getting pretty close to where harvest is coming in. And they started to worry that maybe we're going to have some big crops in the U.S. We know Russia has a record wheat crop that they're harvesting now. So for the moment, Brazil had a very, very large corn crop from the last cycle. So there are fundamental factors said in the short run, it looks like the supply pinch is going to ease back here a little bit, on top of just too many people being in on the trade.
And listen, thank goodness, because nobody wants to see any help we can get to offset what looks like it's going to be a very difficult situation based on supply and based on the geopolitical landscape is much needed. So what is driving ag now? I mean, is it still weather as you look forward? And, are you expecting the correction to continue, or does it feel like maybe we've gotten some froth out of the market?
Well, we've definitely taken some froth out, no question about it. I think right now, given that we've kind of removed the Ukraine invasion premium, we've removed the inflation premium, we're now back to a conventional grain market. The grain market this time of the year, Maggie, it looks at every weather forecast from the models and tries to look out and say, where we are. Mm-hmm. So I think right now weather is in control at this point. And what we're seeing short term, and we've been talking about this for a long time, that we thought we would get a short term, what we call weather scare rally, where you get some hot, dry weather in the US. We were warning about some warmer, drier weather in Europe that would come in for just a little bit. And it happens almost every year. I mean, this is nothing unusual to get a weather scare. We think we're going to get a weather scare rally off of this big break. Technical, we were oversold. Technical bounces, a lot of reasons, but we think we can have a kind of some kind of a rebound rally, maybe a 50% retracement of the decline into the end of July. We would view that as a selling opportunity for our farmers to cash sell their grain. And we would view that as a secondary selling opportunity for those that are, in the trading side of the equation. We think the early harvest lows that we expect this year are going to occur in that mid-late August timeframe. It may be just a retest of what we just saw, but probably we're going to make some new lows in late August before we place the harvest low and maybe settle low for a little while and maybe start having what's called the post-harvest rally as we worry about South American production. So I think most of the big froth is out, and now we're going to trade a traditional growing season, watching the weather volatility going forward into the harvest lows. Pretty traditional now.
So it sounds like short-term rally, but then longer-term downtrend until we get through the growing season. When we talked in January, you were forecasting this major change in weather patterns from La Nina to El Nino. Does that still look likely? And, walk us through what the implications are for that.
For those that don't know or don't remember, La Nina is when the central sea surface temperature of the Central Pacific are colder than normal. El Nino is when the central sea surface temperatures of the Pacific are warmer than normal. And the difference between the two is a Walker cycle, which is an upper airflow pattern that determines which way precipitation is going to fall. Typically in a La Nina, it's a hot, dry pattern for the US. It's a hot, dry pattern for South America. In the last couple of years, we saw plenty of that kind of weather pattern that's gotten a lot of people worried about food and how much we have and who's going to be able to have it and that sort of thing. But we are seeing that central sea surface temperatures warming. In fact, we have now warmed out of La Nina territory, meaning typically La Nina is minus 0.5 degrees Celsius below normal or more. We're now only at 0.2 to 0.3 Celsius. So we have been seeing a steadily rise or warming of these sea surface temperatures out of La Nina territory. And it doesn't mean that it doesn't mean you just snap your fingers, La Nina just ends like that. It's a transition, but we are seeing that happen. The other thing that we talked about, I think last time with you, Maggie, is that the Pacific Decadal Oscillation, or the PDO, was very negative or also very cold, meaning other parts of the Pacific were cold. We're also seeing that shifting as well. In fact, we're seeing that negative PDO weaken considerably. And that's another sign that we're shifting gears. Some of the better longer-term weather models that we like to follow, the CFSV2 and the Jamstack Japanese model, that have a decent track record of kind of forecasting these sea surface temperatures of the Central Pacific, are all pointing to this warming to continue and actually to enter a moderate El Nino by the first quarter of 23. Our independent work that we utilize using solar cycles and sunspots and different techniques that we utilize agrees with that assessment. And that means that we're going to be shifting into a cooler weather pattern for the growing season in the US and in South America, which means much, much better weather for growing bigger crops. Where you are going to come up short, however, typically in the El Nino, is you're going to have some very dry weather in the central part of Africa, the grain belt there, or the food belt there of central Africa. You typically see a big drying out of India, and you tend to see a big drying out of Asia, especially Southeast Asia. So crops like cocoa, crops like sugar, crops like rice in an El Nino cycle tend to get the brunt of the weather problems and the crop shortfalls, whereas things like corn, things like soybeans, things like wheat tend to get a better go of it during El Nino cycle. And that's why we're kind of more on the bearish side of the equation over the next growing cycle, because we think we're going to have a reprieve, this pause in the action, this period where everyone can kind of maybe make some adjustments and get their food where they need to get it before we get into a really, really nasty cycle in 24, 25. So it's almost like the calm before the storm, or down here in South Florida, I've been through hurricanes where the eye comes right over the top and you get this period where it's calm and there's nothing going on. You think it's all over, and then the backside of the storm comes and it's not over. The worst part of it, yes. So I view this next year as a eye of the hurricane over the top, not a permanent reprieve. And I think everyone should be viewing it as such.
So this is incredibly important for policymakers as they try to prepare for this. But let's talk a little bit specifically about, because it's a lot to digest, about the crops that will sort of do well price-wise. Because doing well and having lots of supply could be depressive on the prices. So it's a bit counterintuitive. So if we are going to enter that El Nino period, what are you bullish on in terms of price action with crops, and what would you be maybe paring back on, or thinking that, we're going to be in a period where prices are more depressed, or at least there's some oversupply?
Well, given that South America and North America get good weather, certainly corn and soybeans, cotton and wheat would have would have large crops or larger crops and bigger supplies, and would have the potential for lower prices. And that's why we're kind of cautionary on those markets going into the next growing cycle, into next summer, because we think we're going to have to deal with that first before we can get through that and then get to the other side when we think the weather turns adverse again. The markets that supply problems would definitely occur, or at least have historically occurred, would be cocoa in West Africa. Very high correlated area for drought during El Ninos. We tend to have a lot of problems in India. India is a prolific producer of sugar, prolific producer of rice. And then, of course, Southeast Asia, meaning Indonesia, Malaysia, Thailand, Vietnam, that whole area, they produce a lot of rice. And things like palm oil, for example, would be under some significant, drought type of risks. So those would be the kind of crop markets that would have the potential for having to price in a tighter supply situation going forward. Incidentally, they've been some of the more underperformers here in the last year.
Yeah. I remember we talked about cocoa in January, and you were bullish on cocoa in January. Are some of these trades patient trades? Because it hasn't done a whole lot, has it, up till now?
Yeah, I mean, we mentioned it then, and I want to mention it very clearly now. We are longer term forecasters. I mean, when we look at our hedges, we look at our trading recommendations. We're not looking at, get in today, get out next week, get in today, get out next month. We're looking out 6 months, 12 months, even 18 months, and trying to get in on what we think is going to be a longer term trending market, either up or down. And unfortunately for the cocoa market, there's because Russia invaded Ukraine and we had all these worries over the economy, it spiked inflation. It brought the Federal Reserve in, raising interest rates. It skyrocketed the dollar. There was a lot of headwinds that started to come in that has kind of pushed that trade out a little bit from when we were speaking, when we didn't know that was going to happen. And that's the pivot part of any forecast, to say, okay, it happened. Nothing has changed with our weather forecast, however, meaning we anticipated that by the time we got into the July period, that we would see El Nino weaken, which it is. We would see what's called the Indian Ocean dipole. This is when the sea surface temperatures on the western part of India are blue or cold, and it's when the eastern part of sea surface temperatures on the eastern part of India are warm or orange and red. That Indian Ocean dipole tends to starve Africa, Central Africa, of moisture. We have just seen a very significant dive into negative territory, which is what that cold warm suggests. And the last thing that we talked about and that we mentioned was that something called the tropical South Atlantic, which is the sea surface temperatures just to the south of West Africa. we thought would start to trend colder by July, and they are trending significantly colder, now colder than normal. So these three, what we call teleconnections, are now kicking in. These are the signposts we were looking for to say we're going to begin to move into a warmer, drier pattern. And this is not a 2-month thing. This is going to be a 12-month kind of an escalating dry cycle that we're in. And so we feel, even though the market has hit the pause button from all these outside factors, we think weather overrides all things if it's important enough. And we think we're going to start getting to the point where the weather is going to override these factors, and cocoa is going to start to rally independent of them. And that's so that's where we think we're at. And we think the correction we've had in cocoa, like everything else on this big deflationary speculative liquidation we've seen, looks to me like a very interesting market to be looking at right now, either as a physical buyer or as a trader.
I know you're watching cattle too. So, we're talking about the things we pull out of the ground, but how's the cattle industry impacted by this?
Well, remember, when grain prices are high, it incentivizes herd liquidation, meaning that if a cattle rancher can't afford to feed his cattle corn or bean meal, he won't. If he doesn't have the pasture ground to feed his cattle, he won't. He'll send it to the market because it's no longer an economic incentive to do so. So the drought that we had, which ruined a lot of the pasture growth or the pasture lands and eliminated all that hay and alfalfa that a lot of cattle like to graze on over a period of time, and the high prices for corn and bean meal and such, caused a multi-year herd liquidation cycle. And that created an oversupply in the cattle market. We went through this in 2010, 11, and 12. The last La Nina cycle we were in, when we had the same situation. And then we had the drought of 2012, which was a 1 in 50-year drought. Corn topped out. The rains came back in 2013, and the cattle market entered into a wild move higher that ultimately went to new all-time highs in 2014 before topping out. We feel where we are now in the cycle, where the feed prices come down and we're about to see Mother Nature improve, the cattle market is going to start retaining the animals now. Meaning the herd liquidation phase is going to end. They're no longer going to see the need to push these animals into the market, and they're going to start to rebuild the herd. And that's going to create extremely tight supplies for cattle going forward. And so, these two markets are equal and opposite of each other. When the grains go down, cattle goes up, and vice versa. So where we are in the cycle is really interesting for cattle over the next 12 months, because the weather's going to be good and the feed price should be much cheaper. And it means that the cattle supplies are going to be very, very tight. Even if we see demand have some headwinds, even if we do get a recession or a slowdown, and we feel that the tightness in the market is so egregious that it's still going to override even some of those recessionary worries over demand declines, and we still should have a pretty interesting market to the upside. It may mean we don't go quite as high if we had a robust economy. That's all it means. But it's also a very interesting market that does very, very well on top of cocoa and sugar in this part of the cycle right now.
Yeah, it's interesting. Is cattle more of a discretionary? Because you're talking about, when you talk about some of the other basics, I mean, you need them. People need to eat. They're just the basic food ingredient. Meat, we've seen with the prices that have surged already, some people just eating less of it, buying less of it. So does the economy, the macroeconomic outlook, have a little bit more of a correlation to meat prices, cattle?
I mean, historically, the cattle price is very much tied to the view or the perception of the economy. That's why if you look at the stock market and cattle prices, when the stock market falls a lot, it tends to drag the cattle market down, because the view is that the stock market knows best and it sees a recession coming. But that's under normal times. And I still feel that is happening. We are seeing some demand pullback, but in this, because the herd liquidation was so extreme, Maggie, that in this particular situation, even though that is correct and it is going to happen, it's supply and demand.
Yeah.
And we think the supply is going to be so short that even with a lower discretionary demand for beef, we still feel we're going to have a mismatch. And as I said, it just may mean that we don't quite go as high as we would have gone under a robust economy, but it still means that we have an imbalance that we have to go and find out where is that price clearing mechanism that factors that in. And we don't feel that where we are now, in fact, does that.
I want to talk about a chart that came up just so we're clear on the timeline, because I think, and it'll help as we're looking at the chart. So we're in the middle of a transition from La Nina to El Nino, which is going to bring better growing weather for the U.S. And I'm going to focus on the U.S. for a moment, just because
Sure.
It is a big source of crops. But how long does that last? Because we have a chart in here that you're very concerned about drought in the Midwest for 24, 25, I think. So is the El Nino a sort of year and a half long process as we go into 2023 and then we come out of it? What's responsible for the drought?
El Nino and La Nina are driven by where we are in the 11-year solar cycle. So for those who don't know, the 11-year solar cycle is you go through a period of no sunspots, and then you reach a peak sunspots, and then you come back down. That process it takes 11 years to do. Where we are in that activity level tells you what kind of La Nina you're going to have, or El Nino, and the duration. Where we are in this 11-year solar cycle means that the El Nino we're going to see is going to be a short-lived and weaker El Nino. The stronger, longer El Nino is the one that comes that will come at the peak of the solar cycle 25 that we're in. That's like 26, 27. That's when you can have one of those multi-year kind of endeavors. That's not what we're dealing with here. We're dealing with kind of a short and sweet 1 year, kind of a weak El Nino, going to definitely deliver good weather, but it's not going to be, one that's going to last for very long. And we're going to quickly get back out of that pattern and into something that's going to be heading back more towards a La Nina-like structure. And then we have, on top of that, typical cycle. And this goes on every single 11 years. We go through the same. You could just put it on a map, El Nino. I mean, it's very, very cyclical and reliable. But on top of it, this time around, we have the 90-year Gleissberg cycle, which is triggering in at this time, which makes this cycle very unusual.
Yeah.
You get one of these every 100 years. The last one we had was 34, 35 when the Gleissberg cycle last took place. And that was the Dust Bowl period in the 1930s, which incidentally, by the way, was very early into the 20-year bull cycle in agriculture from 1930 to 1950. It's interesting that we're sort of mimicking that cycle in terms of the Gleissberg cycle is catching on right at the beginning of this 20-year cycle. So yeah. History has a really interesting way of repeating itself with climate and with weather. But for those that, I'll try to explain a little bit what the Gleissberg cycle is. But Dr. Gleissberg studied the sun, studied the planets, and wrote a concept about orbital theory to climate change, meaning that what actually alters the climate on the Earth is the activity and the motion of the sun and the moon relative to each other, relative to the Earth's atmosphere, and relative to the other planets of our solar system, and that all these forces are at work impacting the currents of our oceans. So like the Gulf Stream is with this long ocean current that winds around the whole ocean and keeps it equilibrated, bringing the warm water from the Caribbean up to the north. But what happens during these cycles is that the current actually slows down because of the forces that are applied to the oceans, and it causes the upper airflow pattern to change. So for example, the Institute of Woods Hole, one of the top geographical oceanographic institution in the world, mentioned in a study that the Gulf Stream current is down 15% in the last 5 years, and that trend it's a lot, and it's showing that we are seeing that these forces yet again delivering on the cycle. And remember that the other part of the ocean currents is upwelling versus downwelling. Upwelling brings the cold water from the deep ocean up to the surface, making it cold. That's how you get La Nina. Downwelling forces keeps the warm sea surface temperatures that gets warm from the sun, keeps it on the surface. El Nino. And then there's bigger things like the PDO that we talked about earlier, and also the AMO, or the Atlantic Multi-Decadal Oscillation, which also goes through these longer term cycles of warming and cooling So the Gleissberg cycle is essentially a completion of a complete solar cycle. What Dr. Gleissberg studied and found was that if you have 9 of these 11-year solar cycles, that equals a complete solar cycle. That means that you literally start all over again, meaning that the planetary arrangements, the motion of the sun, its positioning, it's a complete cycle, and then you actually reset the bar, and then you start another 90-year cycle. And that when we get to that 90-year cycle, it sets up the upper airflow pattern for a serious drought. And so we had the 34-35 drought. I think we showed a chart. We talked about the Palmer Drought Index, which is a way of measuring hot and lack of rainfall in terms of soil aridity. And it went over a tree ring analysis that was done and showed that in the 1700s, from 1755, 54, we had a major drought. In fact, we sold bonds in the mid 1700s so we could raise capital to give to the farmers because they had no crops to sell. This is all like in history books if you do some reading on the time. Then we had 1844, 1845, which was another very significant drought. 1934-35, the Dust Bowl, and that next 90-year cycle comes up 2024, 2025.
I can't think of a worse time for this to hit, though, when we've got all these other factors. This is where it's important to lay over what's going on, because we have this, I think, ongoing supply issue that's going to linger based on taking out. I mean, this is, unless there's a speedy resolution, we're going to have lingering supply issues with these grains. So does that in some way moderate the price decline we'll see if you believe this is coming over the hill, or you can't store it so it doesn't matter?
Well, no, you can store corn for a long time. You can store rice for a long time. You can store wheat for a long time. You can store these crops for a long time. I mean, the market won't react to this because not a whole lot of people focus on these kinds of cycles. I mean, they just don't. And that's not. I'm not saying it's anything bad or good or indifferent. It's just most people don't spend their time thinking about what the Gleissberg cycle means. But you're right, Maggie. The Gleissberg cycle is coming at a very, very poor time where we are with everything else going on. I still feel that even, I always say when I'm here in South Florida, and if a Category 5 is coming my way, I still want to know it's coming, because I could still take action. I could still do something to make the situation less dire for myself and for my family and for my friends. And even though I'm not excited about the prospects of having a 1 in 100-year drought, assuming the cycle repeats in 24-25, I still feel that if those that get this message and internalize it and say, you know what if Shawn is right and this cycle repeats again? What can I do as a farmer? What can I do as an end user? What can I do as a country? What can I do as a family to mitigate this? I still think that's a better way to go than to be blindsided, not knowing it's coming, and then be completely unprepared.
No, absolutely. Absolutely. So in particular now, it's so interesting. I had a feeling this was going to happen, Shawn, and I'm so happy we're having this conversation now, because there are so many cross currents and we've covered a lot of them. So I just want to, make sure that we understand it, because I think that a lot of the people who will be listening to this are going to be listening to it from an investment lens. And so in the short term, so let's just do sort of short term, medium term, and long term, because I think that will be helpful. It tends to be how people approach the investments. In the short term, you expect what for ag commodities? What are we going to see? Let's split it up. Let's do grains first, because that's where we've seen the big collapse. What can we expect in the grain market in the short term, and then walk me through the latter part of the year?
Well, I would say, in the very, very short term, I think we began a weather scare rally today. In the very short term, that's going to lead to a rolling back over in a harvest low period in mid-late August. That's the very, very short term. The intermediate term is we're going to have some kind of a typical classical post-harvest rally as we worry about South America's crop. How is it going to go? But by the time we get to the winter time, Maggie, I think that as the El Nino really kicks in and we start to see really good weather down there, the market's going to start having to discount big crops in South America. And then, I'm not the only one that knows El Nino is good for U.S. weather and South American weather. I mean, that's, people who follow agriculture, that's not a secret. Okay. people are going to start internalizing, wait a minute, this is a different cycle. We're going to be expecting some big crops. So I just think it's an overall bearish period for grains outside of these oscillations back and forth. And the more important, meaningful bullish turning point would be next spring, summer. That's when I think that we would be pricing in the worst of the good weather, the worst of the big production. And then we have to start shifting gears to a very rapidly fading El Nino and then entering this Gleissberg phase that we discussed, which tends to play havoc with U.S. weather and other places. So we really feel that the March high in grains is probably the high watermark for a while.
For a while. Sounds like until we get into the latter part of 23.
Correct. I don't really think we're going to see those price levels exceeded until we get into the back half of 23 or even consider it. When we really did turn extremely bearish in our writings to our customers and subscribers in May, that we thought this was an important bearish turning point. So that's the grain markets. The only market that might have a little bit of a different trading pattern might be the rice market, because we discussed how Asia can dry out, and so there could be some issues there. But for the most part, the big grain markets that people really are focused on, it's going to be more of a bearish period. Livestock is going to have a better period coming up. Even though cattle is the poster child for the herd liquidation cycle we just discussed, it's not like we don't see those cycles in the hogs either. I mean, we do. It's just the cycles are shorter, and we have very low animals of hogs in the U.S. And if we get the cheap feed that we're now having, and we get some, we're gonna start looking to grow that herd again and holding those animals back. It's just a shorter cycle. The cattle cycle is like a 2-year rebuild cycle. The hog cycle is more of a kind of a 6-month to 9-month cycle of rebuilding if the farmers really decide to go after and do it. So I would say, it's definitely more of a bullish picture for the livestock sector because of herd rebuilding, keeping supply off the market. Although some demand concerns certainly maybe holding the market back a little bit, but certainly the shortage of supply overwhelming the slowdown in demand. The softs are a complete mixed bag, if that's where you're going next.
Yeah, I was, because yes, exactly. Yeah, talk to me about that.
The soft are really a mixed bag. Cotton benefits because we're a big producer here in the U.S. Even though India can have some trouble with cotton, if we have a big crop, it's going to be really hard for the cotton market to have a bullish phase. So, and cotton is extremely sensitive to the economy, and it's a very cyclical ag commodity, and so it's going to struggle with demand going forward. And so we're not terribly excited for the cotton market because of weather and a slowing economy having a disproportionate effect on demand there. As we said before, cocoa is in an interesting position because West Africa dries out, which means that they've had fantastic weather the last several years, great crops, no problem with supply, and it hasn't done anything. It's missed the whole bull market of commodities and agriculture. It's just flat. But now its time has arrived for the weather to change, for the supplies to change, for the worry to change. Yes, chocolate has a cyclical component to the economy. It does, but it's not as much as cotton. It's a more moderate effect. I mean, it's not a high priced item for families. And for the most part, most people will say, hey, when things are tough, at least I can enjoy a chocolate and a cup of coffee and that'll make me feel good, and so, I do a lot of traveling, and a lot of chocolate are impulse purchases for travelers. And I've never, ever in my entire traveling career seen the airports busier than they have been.
Oh my gosh. I was just going to say, we just bought some chocolate at an airport coming back because we had time to kill, and there was their duty free. And so we took it.
So I think that the demand worries there are overplayed and are not justified. And so now it's just a weather situation. And obviously we have to be right about the weather forecast. I think we are. We're seeing the signpost that we are. Time will tell. But if we're even half correct, I think this market looks interesting. If you look at something like the sugar market, very interesting market. India, a huge. What happens in India, sugar does not stay in India. They're a really, really big player. And so is Thailand. Interesting. They're the third largest exporter in the world is Thailand for sugar. So is, China's a big producer of sugar, although they don't export it. If they come up short, they got to import a lot more. So the sugar market also benefits in this cycle where, it hasn't done a thing in the last year and a half. But this would be an interesting time for this part of the cycle for sugar to do better. And then if we're looking for the orange juice and the coffee markets, Brazil dominates production and exports, and they're going to have good weather. We just experienced a terrible drought and frost period over the last couple of years. Both crops got clipped for 2 years in a row, but now some really, really good weather's coming. Very, very big crops are coming. And so those two markets, should not see any kind of supply shortage once we get to the next crop cycle next summer when those Brazil harvests are coming in. So those markets clearly would be, I would be concerned about prices falling and being under pressure there. So that's kind of the bifurcation between what we see where what has been working probably won't work. And what hasn't been working is probably going to work simply because of the weather cycles. Now, of course, we'll be monitoring geopolitical like everybody else. We'll be monitoring currencies and monetary policy and what we don't know today that happens tomorrow, and we'll pivot. But in the end, Maggie, weather overrides all things if it's impactful enough. And so we're pretty confident that if one is looking at where to place, bearish or bullish trades, I'd be looking for those markets for opportunities. Obviously, everyone has to decide their duration and time and risk and when they want to do it. And we spend our time trying to figure that out. So it doesn't mean go out there and do anything today, but I would be looking for opportunities either on the short side or long side in those markets that we just discussed.
Absolutely. The cocoa and sugar the two specifically, and maybe livestock that will benefit. Again, this is a short El Nino though, right? So that's not a do it and then forget about it for the next. That is only going to be a sort of shorter, mild one before that big one kicks in again at the end of the cycle. Correct?
Right. I mean, so what will happen is that as the El Nino will start to fade over the summer next year and into the fall. And so what we would be probably expecting to see is we would expect to see that maximum El Nino bullish psychology to be had in that late spring, summer timeframe for those markets, meaning peak worry over supply and then weather getting better in those key areas that grow sugar, that grow, cocoa, that sort of thing. So yeah, it's not a 2 or 3 year runway. It's a 9-month, maybe 12-month runway. And of course, as you get closer, you could try to fine tune it. Is it spring versus summer? There's a lot of things that go into it, but definitely, because this is not a multi-year El Nino like we can get, this has a shorter fuse than if it was a longer La Nina where you could have a multi-year crop problem like we had with La Nina. That's not this El Nino. This is a 1 year and done.
Yeah, super important to make that distinction, I think. I want to ask you 2 other things, Shawn. One of them I saw you talked about, and we've discussed it over the course of this conversation, the other factors that can influence, aside from weather being sort of the big dominant macro, but having to look at things like currency, macroeconomic conditions. You mentioned something that's newer in that, and that is a sort of not a shock to the system, but, a one-off that can happen. And this time around, you're looking at this sort of deglobalization, reshoring of supply chains. How is that likely? Is it through the delivery mechanism that's going to be an issue?
Through COVID, through the supply chain debacle, through the continued lockdowns of China, everyone has come to realize how dangerous it is to have a just-in-time agricultural system. It's just perfect. It works fantastic unless something goes wrong. And now that something went wrong and people understand how grave it can be, everyone wants to get more localized, more regional supply chains back on the docket like we used to have when we used to have a stockpiling strategy. So this whole deglobalization that has been forced by COVID and some of these, and now war with the Ukraine and Russian war and whatever else is going on, it's just going to cause greater demand for food beyond normal demand. What I mean by that is that you have, I go out and I eat a burger and that demand has to be fed. But now if countries want to stockpile a year's worth of supply of rice or a year's worth of supply of wheat or a year's worth of supply of corn like they used to have and they don't have any, it takes years to buy more than you need to rebuild those stocks. And of course, if we're at a time of increased weather volatility, that's even harder to do because the good crops don't happen as often as they used to. So that whole shifting from a just-in-time inventory to a stockpiling deglobalization system is really a long-term tailwind of demand that's not going to go anywhere. And is going to continue to surprise on the demand side. I'll give you a great example of this. Cotton, right? Cotton, we've seen really unbelievable demand from China because our cotton in the U.S. is the highest quality cotton in the world, or one of the highest quality, and their cotton over there is lower quality. So they decided that because of everything was going on, they were going to stockpile, even though they didn't need it. Like they didn't actually need it for demand. They were going to stockpile the higher quality cotton so they could have a long-term supply on hand in-house in their country to blend in with the lower quality cotton. And it overran the cotton market. And we ran this cotton market up to $1.50 a pound. Only once before have we seen that in 2011, I guess it was. So that's the kind of thing that's going to happen when a country says, we are going to do this. And it has nothing to do with the economy, it has nothing to do with actual end user demand. It has to do with our decision as a government for national security that we're going to do this and we're just going to do it until we get it done. I think we're going to see a lot more of these kind of sudden demand shocks as we go along, especially as prices get a little cheaper here and the countries start to see that they're getting a better deal. I think we might see some of those come from time to time, and that's to be on the lookout for. And it's very different. We did not see this in the last cycle. In the 2000 cycle, we didn't see this. This is a new paradigm that we're seeing, and I don't see it going away. I think we have permanently scared the dickens out of everybody, and they're going to put more food in their country. Period. End of story. That's what they're going to do.
So interesting and so smart to point that out. Like shorts beware, right? Because you can be thinking that prices are going to decline for a lot of other reasons that make sense. But if you've got a buyer, a kind of permanent buyer in the market, that's super interesting, and that's gonna change a lot.
Well, that's why we spend so much time trying to determine where are we in the cycle. Mm-hmm. If we were in year 18 of the 20-year cycle, meaning we're near the end of the cycle, then you'd have to be thinking things very differently about things. But when you're at the very beginning of a 20-year cycle, assuming that the cycles continue to repeat, and we see no reason why they won't, you got to be very, very careful as a short. You have to be very, very careful because the trend is actually more upside price volatility than downside volatility. Doesn't mean we can't have big breaks like we just saw, but there's going to be more risk to the upside overall than downside risks in this part of the cycle we feel we're in. Whereas the bearish cycle, there's a lot more downside volatility than upside volatility. So you as a person who's long has to be very careful. So in my way of thinking as a hedger or as a trader, buy the breaks is the story, at least for the next 10 to 15 years. Whereas in a bear market, you want to sell the rallies. And that worked great from 2010, 11 to 2020. Selling the rallies was an absolute, phenomenal strategy. Not now. Now you want to be buying the breaks and, being smart about it, being careful about it, looking at the weather cycles, but you want to be a buyer of breaks for all the reasons that we discussed and other things that, that we've talked about.
Last question, Shawn. I got the sense from some of the questions coming in from our audience that people were, in that big move we saw in commodities, it was sort of everything was going up for a little while. So people could dump into DBA or an ETF or a broad vehicle and ride that commodity rally. Sounds like it's going to be different this time. Do people have to be more judicious and really sort of pick the agriculture commodity they're looking at, or can they still think about doing something through a broader vehicle?
For the next 12 months, meaning from now to next summer, early fall, I think you really got to pick and choose. It's going to be a commodity pickup. I don't think you're going to do well with a broad basket of commodities like you did from 2020 to 22. Now, when we get to the latter part of 23 and we get into that 24, 25 Gleissberg cycle, then I think you can be more broad again, and I think that could work. But I think you need to shift gears to being a commodity picker in the next 12 months, not a just own them all kind of a thing. I really think it's a great question, and I think it's really is a different strategy the next 12 months than it's been for the last 2 years, quite frankly.
Shawn, this has been a tremendous conversation. I love looking at all the charts and how deep you go into the weather. It's sort of one of those, we talk a lot about understanding your macro framework before you can kind of take into consideration all these other factors. And you do that better than anybody when it comes to the commodity space. So thank you so much for sharing all your wisdom with us today.
Can I end with one last comment?
Sure.
2020 to 2022, we saw the commodities rise on a rising dollar. I don't believe it's ever happened before like this. I mean, I like a wild inflationary move to the upside with a stronger dollar. I don't recall. I'm sure maybe it happened 5,000 years ago in some faraway place, but I don't recall that that's ever happened. So that really caught a lot of people off guard because there's people that are trained. The dollar goes up, you short commodities. And I think that the great equalizer or the new kid in town was the cryptocurrency asset class and the Bitcoin alternative to gold and silver, meaning that what happened was, even though we didn't see the dollar decline against gold and silver, and we didn't see the dollar decline against other currencies, we had a massive devaluation against cryptocurrencies, like crazy devaluation. And I feel that sucking of capital away from the dollar and towards cryptocurrencies was something we'd never seen before. It totally changed the rules, but it caused an inflationary wave because it took the role that gold and silver will normally take. And so we have to keep in mind that I still see people today say, yeah, that strong dollar is one of the reasons. And I'm not saying it's not. Okay, because we've seen a big decline in crypto. And I think one of the reasons that we've lost this inflationary mantra is because
impulse, right?
Is because the cryptos have crashed against the dollar. And now people say, well, the dollar actually is the only game in town. That brought some deflation fear in. But I'm telling you, if the cryptocurrencies take off again, I'm not saying I am a whiz on. I know Real Vision does fantastic work on it, and they got people that are just way smarter than I am in cryptocurrencies. But if we are in a long-term move higher in cryptocurrencies, because the way I look at the cycle, every 3 or 4 years, we lose 80% in the crypto space in Bitcoin, and then it bottoms, and then we have another surge to new highs. So assuming that trend continues, when Bitcoin takes off again, I think would be your signal that the inflationary psychology might come back into the market that we just lost. And I think that is something that's very different, that instead of looking at the dollar index itself, I'm not saying it's not important, but itself, look at the relationship of the dollar to the crypto and the Bitcoin. I think that might give you a better edge to see the inflation coming like we saw the last 2 years, where a lot of people didn't see it coming and missed a good portion of it because the dollar never actually declined like it did in the 2000s.
So will that also support commodity prices, do you think, if you get that inflationary impulse coming back from a reacceleration in crypto?
Sure. I mean, so let's just say that the crypto space follows the typical cycle. I'm just looking at a pattern here. I'm not trying to say I know what. And typically, you drop 80%. You base build for about 9 months in Bitcoin, and then you start to turn up. So if we think that through, it says that Bitcoin ought to start having one of those surges again sometime in the first half of 23. And it takes a little time, right, for the market to get excited again after it's lost its faith. But if you think, so if I'm right, sometime in the first half of 23, the cryptocurrencies and the Bitcoin is starting to improve, and we start getting in the summer and the fall, one of those famous, straight up shots that are notorious for that space. Let's think this through. We're going to be moving towards Gleissberg cycle. We should have a lot of prices pretty low. We could trigger an inflation worry again, just as we enter what could be one of the, some more substantial weather volatility events that we're going to see in a very long time. these cycles tend to culminate and so I think that's something that I would be looking for. I always try to tell my customers, signposts. We're looking for signposts to tell us we're on the right track or on the wrong track timing wise. I would be looking for Bitcoin to start rallying as a signpost that the inflationary side of the equation is coming back into play. And that allows for the maximum upside to be had if I'm right about what's to take place in 24, 25. And we have this historic 1 in 100-year drought that has been repeated for a long time during this, on this Gleissberg cycle framework. So I get so many questions about the dollar and how did this happen? And it's just my speculation. Maybe there's another reason why commodities went up so much with the dollar going up. But I think I'm onto something, and maybe somebody who's a lot smarter about the cryptos can verify that I'm right. But I think there's something there to this. I
love that you brought that up, and I love that kind of outside the box thinking. And you can be sure we're going to put it to a lot of the folks that we talk to who watch that space.
I appreciate that. And if you hear anything,
we'll report back, Shawn.
Report back. I'm only a phone call away.
I'm talking around Friday. I'll ask him what he thinks about it. No, it's a really, but you bring up a really good point that there are always cross currents in this market. That's why I love talking to commodity folks as well as currency and macro, because there are so many different cross currents that you need to navigate through the commodity market that it's complicated anyway. So you've got to be thinking about things like this. I mean, this is why you're all looking for, why was it different this time? We had some extraordinary, what can we peel off as a one-time event, and what's maybe something that's structurally changing or that may happen again that we need to be aware of.
Yeah. And it's so important not to be rigid in your thinking. Have a plan, have a forecast, have a concept, have a thesis, but have some flexibility to pivot. It's so important. Nobody's perfect. No one can possibly look at all these variables and the variables we don't even know and say, I know for sure. Just be flexible to, twist to the right, twist to the left, jump forward. Don't be so rigid that you say, I know I'm right. I'm just going to stick to it. You listen to what the market's telling you. And I think you'll have a better go of it with the overall trends that these markets have had and are going to continue to have going forward.
And this is another reason why folks who are operating in the macro world need to pay attention to what's happening with digital assets and vice versa, because there is not an invisible wall between all of this. Sometimes it feels that way, but they are continuing to merge and they're going to have impact on each other. And we don't really understand what that looks like now. So fantastic flag, Shawn. We're going to pay close attention to that.
Sounds great. Thank you so much, Maggie. Always appreciate the opportunity. I'm grateful and blessed for Real Vision to give me this chance, and hopefully you'll have me back soon.
Absolutely. You can bet on it, Shawn. Thanks so much.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.